right, boys and girls, it is Sunday, the 28th of January 2024, and we are going to have a look at the week ahead. So this is brought to you by Earn to Trade, funded trader platform service, and Financial Juice, the best squawk service that we use here in Duggan Capital. All right, let's get into it. A very busy week ahead indeed. Monday, pretty quiet. Then Tuesday, we're into JOLTS job openings in the US, 3 p.m. GMT. Into Wednesday, and this is where things really spice up because, yeah, we got ADP, non-farm employment, 1:15, crude oil. But the biggie here you can see is the FOMC statement release from the Fed and the resulting press conference half an hour later. Now, we're not expecting any rates to change here whatsoever. I think the market really is going to be paying very close attention to what the rhetoric, what the wording is, and what we can get out of Jerome in the press conference about how they see things shaping up. And are we actually looking at cuts this year? And so, I mean, if we just kind of drag in Fed Watch tool here for, obviously for this meeting, 31st of January, there is a 96.9% pricing in that there will be no change here, no cuts, obviously no rate rises. But looking through to March, we can see that the probability of a cut is actually been dropping and dropping. This is up around the 80 to 90 percentile for one cut come in March. That's now effectively getting priced out of the market. 46.2% now, dropping pretty much almost by 50%. And the balance of probability is pricing in 52.3% that we do not at all in March. And so that prices in 1, 2, 5, 6 cuts throughout the rest of the year. And look, I think this is really, something's got to break here. Something's got to change because effectively the market was pricing in about between 80 to 90% probability that we would a cut in this March meeting, and now that is pretty much gone out of the market. So nonetheless, US equities have run rampant to the upside for the past, since mid-December, right? So, and they're continuing to look pretty strong, but we're going to look at some of these equities charts now in a minute. I just want to get through some of the macro stuff to look at. So, okay, we've got the week set out ahead here. FOMC statement on Wednesday. Thursday, CPIs out of Europe, initial jobless claims, manufacturing PMIs, ISMs. Pretty quiet relative Thursday. But then Friday, we've got NFP out of the US, looking for 177 there. Consensus prior was 216,000. Unemployment rate to stay pat at 3.7% in the US. Now, we've looked at the Fed Watch tool, NFP coming. Now, it's a bit of a super week coming ahead because not only do we have FOMC, not only do we have NFP, we've got all the acronyms here, but we also have Apple, Google, Amazon, and Meta all announcing earnings this week. And so the shape that is this here. So you're getting Microsoft, Google, AMD all announcing on Tuesday, Starbucks, UPS in there, Boeing on Wednesday, large constituent of the Dow. But Thursday, then you're getting Apple, Amazon, Meta, and Visa all announcing on the same day. And then for the oilies on Friday, Exxon and Chevron. Right. So to say it's a big week is a pretty understated thing here, really. So let's get moving through what we have to look at here. To add to all of this, we have Beijing essentially China sending a battle group out into the sea offshore of Taiwan. And the US has sent this unlucky chap, Jake Sullivan, who is about as useless as a wet blanket to an Eskimo, out to kind of calm tensions here. But essentially, we have 30 planes and 6 ships towards Taiwan, and they've actually crossed the midway point of Taiwan Strait, which is the unofficial boundary between China and Taiwan. So I released a little short video on YouTube about this, and I talked a little bit about this I think last week with the guys in our room, that everyone is pretty calm, and I don't think people really realize the impact that a Chinese invasion on Taiwan would have on US equities. So I can't remember, I think it was The Economist or Reuters had done an analysis on this, and they were looking at a 10% negative drawdown on global GDP if this was to happen. Now, why is this a big deal? Well, it's really a big deal because TSMC is a chip manufacturer in Taiwan, and they essentially make 90% of the world's highest performance processors. Okay, so you've got your Intel i7, i9 processors, your NVIDIA AI processors, all this stuff all coming out of Taiwan. And this is why we have the chip in the States, is to kind of of develop some of this high performance chip manufacturing in the US and take away some of this sort of point of failure responsibility there is Taiwan. That's how big it is. So if China actually get in there and start the invasion, I think we're coming down. We're going to start to come down on equities pretty fast. And I think, the week that happens, we will probably wipe out 10% across NASDAQ, SPOOs, and potentially the Dow all in one go. I think that's that's how I would see that. That's how I would look to trade on that. All right. And so just to give you a little bit of flavor here as to what is going on, where we are geographically, you got Thailand, China, Taiwan. And so the midway point is right in here, obviously. And so they just crossed over. So they're getting very close here to Taiwan. And, it's a little bit like the Russian invasion of Ukraine in that, a lot of, people saw the troops mounting on the border, and everyone was saying, well, they're just, saber rattling. And then, hey, presto, guess what? The invasion happened. So I think if it's going to happen, I think we're probably 3 weeks away from this happening. So, am I saying that equities are going to sell off 10% in the next 3 weeks? No, but I'm just aware that this may happen. All right. Okay, moving on. The Boeing shit show continues, guys. The Boeing shit show continues. All right. Alaskan Air last week, CEO said loose bolts found in many Boeing jets. All right, many Boeing jets. Now, it's look, if you're trading Boeing on this, I hope you're short. I certainly would be. Well, I'm not touching it. But here's a bit of a timeline here. I'll post a link to this tweet here. But you see there's a litany since January 5th through to January 20th of just, the worst possible releases here and things happening to Alaskan Airlines, but mainly Boeing, right? So look, if you're short Boeing, it's not a dip to buy, lads. I mean, it's toast. It's toast. It's moving on. So where is the largest weekly inflow to EM equities ever going? Okay, so the emerging markets equities, so you might not think it, but China is actually in the EM basket, emerging markets basket, and it constitutes obviously a huge percentage, 30% of the entire basket. Now we're seeing here from Bank of America Global Investment Strategy that we're seeing the largest inflows into those equities in history coming in. Okay, now why is that? Well, if we look over here, another article from Bloomberg looking at China historic flows into emerging market stock, and you're seeing that this MSCI China index here at these I think these 10-year lows here. So last time we were here was around 2014, 2013. Okay, so it's cheap, right? It's cheap. So why are the inflows in there? Well, you buy when there's blood on the streets, guys. Okay, so you got to be careful out there. And like even some of the smartest guys in the world were trying to buy this dip, and they're now out of business. So look, I've never invested in Chinese index or Chinese companies, but I really want to see how this plays out, because you're seeing obviously US equities crushing into these all-time highs on NASDAQ, Dow, and it's completely the other picture in Asia at the moment. So all right, over to oil. The Red Sea situation continues. The Houthis having a successful strike on an oil tanker, actually I think on Friday evening, but added to that, we are seeing this bid up in oil. Now I've been banging this drum for maybe a month now, since at least mid-December, that we are going to lift out of this area. I think I said 68.90s, was it? Yeah, it was 68.90s that I thought we were going to turn, and we did. We'll look at that chart in a second. There's a real tightness in the oil market, I think, that's been there for 3 years now, to be honest, just after COVID. Looking at this, what is this? Okay, US refiners are planning for the heaviest season of turnarounds on record. Now, what is the turnaround? So the refiners make the distillates, the diesel, the petrol, the gas oil, the heating oil, the jet fuel, all that stuff. And they've kind of delayed doing a lot of maintenance work and safety checks and all this sort of stuff over the last couple of years since COVID. And they've delayed it so much that actually now it's going to take them up to 2 seasons to get to where they need to be. Why am I talking about this? Well, it's because if these refiners have to shut down, normally that's a pitter patter to the seasonal pattern of oil, and it really kind of drags on price. But if they shut down for a large amount of time, you're then going to see builds on Cushing, especially for distillates, but you're also going to see that it may just scupper the bid in oil, because these guys effectively aren't going to be buying while they're in maintenance. They're going to be running through stocks that they already have, are coming up to the maintenance, and then they're going to make sure that they can get right back to it, and they have plentiful stocks at their facility for when they come out of maintenance. So I actually think this could be a drag on oil, but net, I think everything is so strong for oil to go to the upside, mainly driven by the Red Sea picture and potential escalation of the situation in the Straits of Taiwan at the moment. So have a read. It's a pretty short article. That's it really. Okay, looking here, as you can see, we're talking about these shipping rates. We've been talking about the shipping situation here. Here's a lovely just chart from Citigroup, really, naming the trade, which is, these shipping rates are going to the north side here, including Shanghai to LA. Now, a lot of people wouldn't have thought that was going to be the case because, China is going to be shipped eastward through the Pacific rather than all the way around Africa and, through the Panama Canal to get to LA, right? They're going through the Pacific. So there's no risk there, right? But now, as the risk of China invading Taiwan becomes a little bit higher, and with ships and planes moving around the area now, we may be on the foothills of an invasion, and that is going to maybe increase the insurance for the Shanghai to LAs. But definitely the Shanghai to Rotterdam is no surprise. The Red Sea crisis is definitely, putting longer times, bigger insurance premiums on those cargo. Credit, something that we all really don't give a shit about, just as long as they have our money. But bank credit, all banks in the US, percentage change from a year ago, we are way down here on credit. So, what can we do with this chart? Well, nothing really, but I just wanted to know where we are in relation to like the 70s oil crisis, the 1991 recession crash, DFC, where we are now, and then where we're about to be. And so Jerome, look at Jerome here in his prime, looking good, isn't he? I don't know what he was doing back in the day, if he was a trader or not. I don't think he was. Who cares, right? But the point is the Fed are ending the BTF program, the Bank Term Funding Program, and this has really had a lot of these smaller regional banks, right, and the non-SIBs, systematically important banks, SIBs like Morgan Stanley, Chase, all these guys, right? Those guys are kind of fine. The SIBs are kind of fine, but the smaller banks and the regional banks are pretty screwed, and a lot of them were really sweating when Silicon Valley Bank went to the wall, and they had the bank depository insurance kick in, and that was steadying the waters a small bit from there being a general bank run on all these regional banks. But what really backstopped the whole issue was this Bank Term Funding Program, essentially providing a safe haven for the banks to park their assets, which were US bonds, which were way below value, market value. They were basically marked being pretty cheap or worthless in face value because of the rising rates on the treasuries, the 10 years, the 5 years, the 2 years, the 1 years. Okay, all right, I'm getting a bit out of the simplistic here, which is kind of where I want to stay, but essentially I see this, as many do, as being a huge risk to the banking system, and this ends on March 11th. So just keep your spidey senses switched on for March 11th, see what kind of comes in there. Does something get priced in on equities? Have a look at KRE index. You're probably going to see some jitters there first, if anywhere, but otherwise, this could be just a big massive nothing burger, because the entire universe knows that this is ending March 11th, and they have changed a few terms on what was expected to be how the bank finished up the program. But yeah, just a bit of a nothing burger. I think it's going to be a bit of a nothing burger. All right, Tesla. Let's talk Tesla. So this was the bad earnings down. I think it was about 10%, something like that. Was it? Oh, well, yeah, this snapshot was a 5.6. I think we were just shy of 10% on the gap down on the next day. But I wanted to really look at Tesla on the bigger term picture here, right? And so this is Tesla here, monthly bars. Here's the all-time. We don't need all that stuff down there, but we go to just, probably from 2018 up here, right? And so look at how we're just breaking down through this area, and really looking at this chart, the only potential supports to come in here are actually like way lower. So I mean, you could be looking at the 121 or somewhere, well, let's just call it 120s here, but the ultimate support for me is actually at $63 on a pullback. I mean, that is a huge evisceration of value for this thing. And if you then look at a logarithmic chart, which kind of normalizes a lot of the whipsawing and massive up days and months and weeks you can have in this system or on a chart, it kind of normalizes the data in a better way. You can see down here, I think when this is all said and done, if Elon doesn't pull another rabbit out of the hat, man, I think this thing go back down to about $26. And you tell me I'm insane. You tell me, but tell me why it's the same. Because technically, I just see a massive free fall for this thing here, massive. So yeah, let's just mark off that 26 area there. All right, that's enough about Tesla. S&P tech stock relative strength versus versus the broad market. So yeah, I just wanted to note this chart. This essentially shows the relative strength of the tech sector of the S&P to the S&P since 1989. And guess what? We're back to where we were when a little old thing called the dot-com crash happened. And so I think we could run a good bit more here on tech. I really do. I mean, I think we're probably going to have very strong earnings out of these tech companies this coming week. I think the Fed will be a bit of a non-event unless Jerome sounds incredibly hawkish and, that he's only going to maybe do 3 rates cuts this year. But unless it's that, I think we're probably going to get a new sort of high in this relative chart here. Anyway, I don't want to get into this too much. And then actually just to finish on oil. So I told you that US crude production was coming back into the boom numbers and really high production numbers, and here we are. Here's a chart from the EIA, courtesy of CNBC, just showing you that coming out of those 68-year lows in 2008 here, we are now rallied up to a production as of October 2023 of 13.25 million barrels. This is phenomenal production out of the US here. And while the Saudis are cutting and trying to tighten the picture, that's just music to an oil producer's ears in North America, because it pushes price higher, and then they just get as much as they can pumping out of the ground and selling it at these elevated prices, and they'll keep doing that until it feeds into lower prices. Okay, so they'll keep pumping until that higher level of production either A, runs out and they can't sustain it, which will actually mean higher prices again, or B, B, that the market just can't take wherever we're going here on price. Is it 150? I don't really want to talk about $200 a barrel just yet. I think that'll be actually like maybe a 2020, late 2025, early 2026 story. 150 maybe this year could be on the cards, but let's see what happens in China and Taiwan. Okay, been talking way too much about all this. Let's get over and look at some of these charts here. And so we're going to start off dollar. So looking at Dixie. Here we are on the daily bar chart, and you see this big old bear flag out over here. Sayonara dollar, and down we go into this sort of low that we had in June 2023 here, and seemed to try to steady off there. Went into the lows then we had in 2023. In April 2023, and then kind of ripped higher. But I think that it's going to be impossible for me to call something here on this. But I think generally when things break on the bear flags like this, they do tend to take out the major start of where the channel began, right? So I think long-term 2024 picture is that we take this out unless we get massive escalation or even modest escalation of the war risk to being a full-on situation, with China, Taiwan, Israel, Gaza, Russia, Ukraine, and God knows what else is coming. But either which way, it's going to be hard here what's going to happen. But I'll just take a stab at it. Let's just plant it like that for the year, for the dollar to go further lower. And I'd be loving that one as someone who lives in the Eurozone. Moving on to NASDAQ. So as I was saying that we were just talking about the NASDAQ, here we are again, daily bars. Now, last week on Wednesday here, Tuesday, we actually pushed up into the back adjusted all-time high, which is at 17,722's quarter. Pushed up, tagged that new high, and back down we go. So I think the market has really done a great job here. It's been a phenomenal run. Could we go higher? Yeah, we could always go higher. I mean, we will over time. We'll definitely go higher. But, over the short to medium term, I don't think so. I mean, when we were down here, I was calling us for us to pull down to the 16,062s. Didn't get it. We broke further higher. Take out that back just at all-time high. I think now that we've tagged it, it's going to be interesting to see where the buyers want to try and come in again. But I just don't know. I mean, I don't know. I'm not going to look at it too much, but I think 17,421s is going to be a big pivotal area for this market. And I think it's going to be pivotal early on in the week. So by Tuesday, we should be either ripping or dipping off this one here. So keep that in mind. And do please put that on your chart. 17,722 quarters here. 17,722 quarters as that back adjusted prior all-time high. Just keep an eye and see if we run into any problems there on a re-push. But if earnings are good out of these tech companies this week, we're going to go even higher again. And is that possible? Yeah. The SPOOs, look, there's only one thing that this market wants to do, and it's to take out that 49.5s, which is a prior back adjusted level. And then the prior all-time high back adjusted is 32's half. The charts you're looking at here these candles are not back adjusted, okay? But these levels are back adjusted, just to make you aware of that. So look, could we have a little pullback here into like the 48, 41s and then move on? Yeah, I think we could, but I don't think I want to get involved until we get that. We're looking for a long. I don't think I want to get into looking for shorts on this until we get into that 50.32's half, back adjusted prior all high there. So I haven't got much to do on equities. Obviously, if you're in the Duggan Capital room live during the day, we are looking at day time frame trades in the Duggan Capital room, and there will be lots of stuff to look at in there. The Dow has taken that back adjusted all-time high out now at 38,280s and made a new one. Could we keep ripping here? Again, really would like to wait to trade equities towards the end of the week, probably maybe even wait until Friday for a nice big trade, but there may be some scalps in between Monday and Thursday to keep us happy. But otherwise, we are long oil here in Duggan Capital, and we are loving this one. So if we get on to oil, look, we were in down onto that, what did I say, 68, 90s, 80s, 68, yeah, we just call it around there, 69, 68, 90, 68, 80s there. Anyway, we dipped on that and we're consolidated for what seemed like eternity here in this whole area. But I was talking with the guys in our room live several times. A lot of us are spread trading. We do offer training on spread training, but it's a great way to trade. Essentially, once we started holding over the 71.60 numerous times, we're trading very careful, able to take deep pullbacks here and scale into longs and have a bit of that hedge, and then just drop the hedge as we push back over 71.6. And here we go to the upside. I think ultimately we're getting back up mega trend here, and let's just call it $80. I think let's just call it what it is. It's going to be, well, yeah, I mean, we've already broken through the 77.62s. Next up for consideration probably just going to be here 79.77. So let's just call it $80, will we? And save ourselves a lot of time. And 81.50. Now, obviously, this isn't going to be one straight line, so do be aware of these levels. 79.77's upside for oil. We are going to be taking in some of the longs here, pairing for a pullback. So taking off some longs, scaling into some shorts, getting ready for a rough ride pullback, and then who knows where and when we're going to lift back out, go for the 81s. But market on 79.77s. There will be turbulence here. If there is an escalation of the situation in Taiwan, then I think we are going to cut up through that $80 handle like it's butter, and I think we're going to go straight to 81.50s, and then we'll be 84.05s pretty quickly, and then there may be a pullback. Okay, but do keep an eye out for that this week. Oil, major supports, actually, just before I go, major supports for a pullback. Yeah, I think 70.30s if we were to have a major sort of pullback here on oil. 73.30s, buy that dip and keep going up. And this is not investment trade advice, is just what I'm looking at. Yeah, so to round it off, pretty busy week ahead. Monday going to be super quiet. Tuesday, some of those earnings coming out there, probably some volatility into the markets could offer up some really decent trades. Wednesday night is going to be really interesting, especially if Jerome comes out hawkish onto what the market is expecting as 6 rate cuts through the rest of the year. So heavily watching there for hawkishness and see what the FOMC think about where their rate cut trajectory, if you like. And then in the wash of that Thursday, it's going to be pretty interesting, I'd say, to trade Thursday. And then Friday, you got to wait. You'll have more of these earnings, having come the night before. Then you're going into NFP. And I think you'll probably get some nice mispricing on these markets on NFP on Friday. So yeah, listen, if I don't see you in the Duggan Capital room, we will be live covering the FOMC